Big blunts, dope boys wanna smoke with me. Now we ride double M's through the whole city. Niggas talking down, but they always feel me. A 9-figure nigga, all I wanna talk is business. I seen a big mouth get a closed casket. Self-made, took over the whole racket. A kilo after kilo, see who moved the most. 200-foot yacht, she wanna see the coast.
What's going on, YouTube? Welcome back to Goofy Investing, where we talk about investing in the stock market. This channel is more specialized towards your mid and small cap growth investors. A lot of requests on this company. Today we're going to be taking a look at Angx Studios, ticker ANGX. This is a stock that recently SPAC'd on the New York Stock Exchange and where it trades for $3.96 a share. Market cap is $636.42 million. As you can see, this polarized chart of when they SPAC'd, they went up. They went from hero to zero. Obviously, is an exaggeration. They're not at zero, okay? But we're going to take a look at the financials. We're going to take a look at some of the business model. We'll cover a little bit of the 8K. I don't want to put too much stock into the 8K because, you know, it is what it is. It's an 8K filing. The 10Q is probably going to have more specifics on things going on within the company. And ultimately, the 10K, the annualized 10K is really where it's at, because the actual annualized 10K will have the actual auditing of the numbers and all that good stuff. So you could take it to the bank that all the numbers are accurate. Due to their recent SPAC onto the New York Stock Exchange, some of the softwares haven't updated properly just as of yet. Keep in mind, they don't even have a publicly traded quarterly earnings report yet either. So take that under consideration. All right, let's dive into some financials here. Let's get a sniff check of the balance sheet. Right now I'm tracking, they got debt of 42.07 million, and then they have cash and or cash equivalents of 28 million. Reviewing their investor slide deck, their 8K and etc. A portion of this cash could be in Bitcoin treasury or in Bitcoin, if you will. I'm tracking they hold from their last investor deck that was released in June 13th, 2025, they've pretty much cited that they have 303 Bitcoin. All right. So that's something to consider. So there's something to be said about that. All right. So if you own this company, you have a play within, like a third party play within owning the Bitcoin within the company, because when you buy the company, you own their assets for your share of stock that you buy. All right. So there's that. Brand new growth company, no dividends. Earnings, one analyst. So when they SPAC'd, they have one analyst covering the company. I think that's okay. I really take the actual consensus estimates with a grain of salt this early, and them only having one analyst. You have to start somewhere, I suppose. As the company continues to grow and more time lapses, more fundamentals as far as SEC filings, quarterly reports, projected guidance, all of this good stuff starts coming into play. Some more analysts may start jumping on the bandwagon and covering this equity, and that'll give the street more eyes onto the actual stock. All right. So consensus estimates on revenue growth. Let's look at what they've done in 2024. All right. In 2024, they did 96.5 million in sales. All right. And consensus estimates for the end of this year got them at 281.88 million. All right, in sales. Now, keep in mind, the software, like I said before, it says K right there, like, so it appears that they're only going to do 281,000. No, these are numbers in millions, guys. All right, so I've already confirmed that part, but let's do some math on it. All right, because your growth rate is not going to be established right here from the consensus estimates. So if they did 96.5, if they did 96.5 million in sales, and let's say that they grow in accordance with that one analyst's consensus estimate of sales growth, that means, oops. So I'm sorry, bear with me, guys. All right. 96.5. We're going to do the math. And then we'll go to the consensus estimates. We're going to divide that. And what we're doing is we're establishing the initial growth rate. We'll add 134% growth year over year. This is a growth company, all right? Whether they actually do those numbers or not, that's yet to be seen. However, I mean, they're pretty much on the right track of hitting that mark, depending on whatever deals that land. There's still a good chunk of sales that need to be done, and there's still a couple quarters to be reported on, all right? Going back to it, their market cap is 636.42, all right, million. If they actually hit that, mark, 642 divided by, I'm just going to do a rounding error, guys. And we'll just call it, let's say they beat they're at forward sales on a valuation metric, they're trading at 2.27 times sales on a forward metric. All right. So that can be appealing for a company growing over 100% revenue. Okay. So that could be a decent proposition. Let's look at some profitability metrics. 65% gross profit margin. Honestly, I assess that for being enough for the initial get-go. So there's probably a lot of room to expand that gross profit margin if they start enabling their licensing portion of their business, because that is a high margin arena. Okay, what I'm going to do is I'm going to do a duplicate tab. Let's look at Netflix. So right off the get-go, they're pretty much, I mean, they're beating Netflix's gross profit margin. And Netflix commands pretty good matured margins off that 48%. So obviously this is yet to be seen. These are projections right now for EBIT and EBITDA. They're in the negative 50s, and the net income is mid 50s. Leverage free cash flow, negative 35. So all negative metrics is on profitability. But this is pretty much the investment proposition of when you get into a brand new company that's new to the market. Obviously, these numbers are going to get more finite, detailed, and more accurate as the company starts reporting on quarterly to quarterly basis. All right. Let's talk a little bit more about the company itself. All right. Headquartered in Utah, this is a social media movie studio production company similar to a Netflix. They have an app on the phone where you can watch shows and movies on there. And then they have it, of course, if you have a smart TV, you can download the app through the Roku device or what have you. And they have a subscription model, right, where people can pay a subscription fee monthly or annually. And they have they have a couple tiers there. We'll talk a little bit about that later. They also sell Blu-rays, DVDs, some books, and then they do provide some licensing and products and such. Their strategy of growth for funding the operations of this business has been more of a community investing approach where they actually allow the fans to invest in the company. So that's pretty interesting. And I think it could be an effective strategy because investment of capital costs a lot of money to get through with investment bankers and institutions and so forth. All right. Let's take a look at some. I want to take a look at a couple more metrics before we move on to the business model. Shares outstanding. All right. So they have their basic weighted average shares and then they have their diluted weighted average shares. No gap there. So that's something that I like to see. Diluted weighted average shares are pretty much convert inclusive of convertible stock options and so forth. The spread between the gap between the basic weighted average shares and the diluted weighted average shares is pretty much the basic weighted average shares is what's current outstanding right now, and the diluted weighted average shares takes under consideration vesting of future stock. All right. So that's food for thought. If you haven't, if you didn't know that so far, there it is. All right. Cash flow activity, negative net income here on the trailing. They've lost 100 million. That's typical with these growth companies. They are issuing out more and more stock, and I would expect nothing less for this high growth company and opportunity. And here's the way I see. This is the way I see dilution and issuance of stock with these companies. It's the nature of the beast. It's really, this is how the companies fund a lot of their startups, or as far as these new growth companies, it's pretty typical. So nothing alarming there. All right. Um, Before I get into the investor deck, all right, let's take a look at some notes that I've taken off the 8K, dated September 16th of this year. So um, nothing crazy that I've seen in here. Auditing checks out as far as they have an actual auditor registered under the PCAOB that's been servicing them for 16 years, and then they're going to continue to service them on their journey as they're a public company. All right. The 8K I'm going to take with a grain of salt. 10Qs are quarterly statements, but they're not audited. All right. So Americanized standard in capital markets is an audit will happen annually, and that occurs on the actual 10K statement. All right. Me personally, as an investor, I do not like to invest in companies that do not have a 10K in a proper audit yet. This is a personal standard that I have within myself. Everybody else can do what they want, and that doesn't necessarily mean it's good or bad. That's just what I do personally. All right. Um, so something that caught my attention with the business model is litigation. All right. This company has had some lawsuits that they've been fighting in court or have fought in court, and this is pretty typical with media companies, whether you're Time Warner Bros, Paramount, Netflix, whatever. In this industry, there's always going to be some sort of form of lawsuits, whether it's from the actors to the studio production company, or whether it's from one stream site to another stream site. Intellectual property of content comes into play, licensing, and so forth. There's so much stuff that legally is in play when it comes to patents and IP with these companies. So I'd expect nothing less. But what caught my attention here is one of these suits that had to do with ClearPlay. Is this company had a technological feature where it went their actual platform went in and they were able to alter content in the way of censorship. So what I mean by that is maybe if you pressed a button on there, if there's a scene of nudity, it would censor the genital parts that were exposed. If someone said a curse word, it may bleep it out or change the word that the person said. That type of idea. And this actual IP was pretty much from this one company called ClearPlay, and ClearPlay took Angel to court, and essentially, bottom line up front is they pretty much settled, and and that actual IP property is no longer used from what I understand. And what came of it on the settlement is there is a royalty to be paid, 1.8 million, to be paid through 36 monthly installments of 50,000 per month. Okay, so that's something to consider. So that's about every quarter on the statement when they release their 10Q or when they report their earnings. I'm probably going to be looking to see that 150,000 quarterly outflow. All right. Not the end of the world. I think that now I'm curious to see. I think that this expires at 1.8 million. But it's a royalty, so I don't know too much of the details. I think the 10K will put a little more, shed some more light on that. All right. Um, so litigation is going to be constantly a thing with this company, which it's typical. If you're going to be an investor in this company, you're going to have to just deal with it, guys. I don't know what to say. There's probably going to be more lawsuits to come one way or another. Maybe they're suing someone or someone's suing them. It's just part of the business. Okay. Another thing that I've noticed here is different classes of shares. All right. They got class A, B, C, they got F shares and so forth. And these different shares have different voting rights. I'm going to be waiting more specifically for the 10K to outline how each share class is going to be able to participate. If you're investing in this company, which the shares that are outstanding on the actual market for trade right now are class A shares. Okay. So I'm tracking the class B shares have a 50-1 voting power. The class A shares have a 5-1 voting power. Um, how these different classes of shares and how the company intends to attrition one class or another moving forward, it's kind of yet to be seen. I'm going to need a couple quarters to do more analysis on actual statements that get released. All right. So if you're an actual investor in this company, consider, you might as well just subscribe, because I'm going to be following up with this company pretty regularly. I'm going to be keeping my eyes on the company. So if you're getting value and you're learning something out of this video, thumbs up, guys. All right. Thanks for the support. All right. So let's go to their investor deck. All right. So they were founded in 2013. They're still founder led. And three brothers out of Utah, I'm tracking the Harmon brothers, and I'll show a photo here in a bit as we go down and talk about their investor slide deck. They took the company public, they built it from ground up, and they have these guild members here, paying angel guild members. It's pretty much another term for how much these are the subscribers to the service. Like someone subscribes to Netflix, the guild members is the person who subscribes to the angel app here, as you can see. All right. And they have 5 million plus downloads on the app, 65 million app installs on mobile and TV, 9 billion plus views on all platforms, various platforms from their content and stuff. They have cinematic releases. I think right here we saw, yeah, this is an example of a movie here, Sound of Freedom. It's one of their movies, and it's got the guy who played Christ in the Passion of the Christ there. And the actual content proposition of this company is different. All right. And then the way and the mode that they have their business model is different. So let me explain. Typically in the Hollywood industry, if you want exposure and promotion to get to the theaters, launch a show, you have to go through these certain gatekeepers through Hollywood. And there's a whole, I guess it's a bureaucratic process, but it's kind of, you're talking to the right people to the next step in order to launch whatever movie. And I don't know, maybe there's someone handing them an envelope of cash and they're like, okay, I'll sign off on this, I'll have this studio do this or that. um, this company gets rid of all the bureaucratic channels of gatekeeping through the Hollywood system, and they pretty much streamline it their way. And the Angel Studios, um, they have a model to where they take less. They don't do fees. They don't do this or that. So you'll have a more streamlined process to get there and have launch a movie. All right. And you won't have to, worry about, I don't know, how do you say, Justin Bieber at the Diddy house with the baby oil situation. You don't have to worry. People don't have to worry about going through the crazy gatekeeping rituals of Hollywood or whatever. So I think that's something to be said about this company. That gives them internal operational moat for expansion. As crazy as that sounds, guys, but I do assess that as a moat for this company. Now, with that being said, their actual content media, their actual content or the aura of their content is more family oriented, or at least for everybody's view. What I mean by that is they're you're probably not going to be seeing blood and gore and sex films and movies with a lot of curse words that launch that Angel does. Okay, so there's that to consider. I think in the world of 2025 that's saying something. um I don't think that you need to, in order to have a movie, that's successful, you don't have to have blood and gore everywhere and cursing and all that. So I think that that's a good idea. All right, it's something different, and gives their business model something to be said about. All right, so I like that about them. Now the Rotten Tomatoes thing. So the guild predicts the winners. I take this for a grain of salt because depending on whatever movie launches, it could be a huge success and it can sway the ratings one way or another. But I guess this is cute. All right, the Rotten Tomatoes said that the Angel Studios is probably going to be the most competitive out of all of these cohorts, including Netflix and so forth. All right. Now, even though they're doing theatrical releases, they are pivoting away from that business model and depending more on actual reoccurring revenue through subscription models through their guild members. All right. And that's something that I like to see. It's a great financial metric for the street to start doing analysis later on. And we've seen radical growth in their guild members from, trailing 2023 to 0 million to 65.7 million to date. Okay. So there's that. Let me see if I want to break this down. I wonder if they have here's one more thing. Okay. So here's their management team. Here's the three brothers. You got Neil Harmon, the CEO, Jeffrey Harmon, the CTO, the chief content officer, and Jordan Harmon, the president. Okay. And, these are the brothers out of Utah. Here's their little resumes of education. And they pretty much took this company from the beginning. And then now they have launched on the New York Stock Exchange, a huge accomplishment. Congratulations to them. And also providing, future potential investors an opportunity to participate in the growth of the company. All right. Um, Here's that lawsuit we talked about on their timeline, and even on their 8K, they've pretty much expressed litigation is a part of their business model. So there that is. Okay. Um, so here's a little bit of here's a little fun fact. Here's different movies and television shows that Angel Studios is behind. So that may or may not be recognizable to some or most. Okay. So there's that. Now, here's that actual business model as far as their subscription base. This video is running out of time. All right. I'm going to try to speed it up. We're almost done here, guys. So basic, they got their basic membership, $12 a month, or they can save annually, which I like. That is a great feature. And then they got their premium membership that you get earlier access to earlier releases. You'll get some 20% off at a merch store. You'll get a couple movie tickets to some Angel theatrical releases. So there's that to consider. And these are the guild members. All right. So that's pretty much their business model here. There's more to it than that we can talk about. They did have a actual funding. They actually had a raise here of 100 million from Trinity Capital. Now, this Trinity Capital specializes more in venture private debt. So they draw debt from the private markets and they provide it to high growing public companies such as Angel Studios. The terms of it are not specifically explained, but if this says that, they're going to provide 100 million for growth of capital, and there's pretty much the assumption that the deal is still being worked out. No, I don't believe that Angel is going to get 100 million up front. I believe that the terms of the deal that they work out is pretty typical to where Angel Studios will have to meet certain metrics to release the next tranche of liquidity. For example, Trinity might say, okay, you need to grow subscribers by 25% in these 2 quarters, and then they will release the next 20 million of loan liquidity. Something to that extent, for example. That's pretty typical with these actual loan, these obligatory, how do you say, contractual agreements of milestones to be hit. If you're getting value out of this, consider checking out my Patreon, guys. I got a lot of content on there. You get access to deep dives, community development, price targeting. I teach you how to value tech, intellectual property, patents. We look at different business model angles. We do price targeting. All right, do a lot of research. You get access to a lot of the latest and greatest research that I'm doing and so forth, and you get more direct access to me. All right. Um, $10 a month, really can't beat it. Check out the 7-day free trial. If you don't like it, just unsubscribe from it, and then move on. You got nothing to lose there. I think it's worth more than that. So that's pretty much my take. I think for me, it's a little too soon to consider investing in this stock just because they just went public. I got no 10Ks. I want to hear how management handles stuff on an earning call. I want to see some more stuff out of this before if I decide to consider investing. All right. I appreciate everybody's support here. Thank you all for subscribing. Comment down below. All right. If you have any questions, I'm always listening to the audience. I will respond back. Say I'm subscribed. I'll respond back. With that being said, I love y'all and take it easy till the next time.